Hi friends, be fearful when others are greedy, but be greedy when others are fearful. This is one of the most famous lines from legendary investor Warren Buffett, and many investors, in fact, know that and have it sort of written on their heart. But few investors actually follow it. Because what Buffett's indicating is don't trust the masses. Don't invest like the crowds. When others are selling, be buying. In front of last year's shareholder conference, Warren Buffett confessed that there's one book he reads almost daily. It's a book called Margin of Safety. It was written by also legendary hedge fund manager Seth Klarman. Klarman manages and founded the 11th largest hedge fund in the world. And he has averaged nearly 20+% returns for the last 3 decades. So investors and shareholders perked up to sort of glean something from both Buffett and Klarman's shared investment style. And the book is nearly $3,000 on Amazon and a lot of pages. So let me boil down 3 really important principles from the book that both Klarman and Buffett share. Number 1, like the title indicates, both Buffett and Klarman believe every investor should have a margin of safety. How they define that is if you believe a stock is worth $100, don't buy it at 95, buy it at 85. Because you make your money when you purchase something, either by overpaying or underpaying. And so Buffett, Klarman, and as do we, believe that one of the best ways for investors to de-risk or reduce risk is to focus on buying undervalued assets, creating a margin of safety, because there's lots of things we either can't account for or simply get wrong. And that margin of safety allows us to minimize risk to some degree. Number 2, avoid losses. Most investors simply want none of the risk and all of the upside return. That is not an investment philosophy, that is a fairy tale. So what does it mean to avoid losses? It means to be able to minimize or mitigate your downward participation, which greatly enhances your recovery. And ultimately, it just comes down to math. Let me give you a quick example. If you had $1 million and the S&P 500 went down 10%, you now have 900,000. Let's say the S&P immediately recovers all 10%. You, though, don't have $1 million again. Because you went down by 10% to 900,000, your 10% recovery only takes you back to 990. However, applying a strategy like Klarman and Buffett have, and a strategy we use for our investors and families across the country, is what I call the 85-90 rule. If you can have only, and this is roughly, 85% of the downward participation of the market, but get roughly 90% of the upward recovery from the market, you're better off. And again, it's just math. Let me show you. That same $1 million, instead of going down 10%, you only go down 8.5%, or 85% of the downward participation. So that million is now 915,000. And when the market recovers 10%, you don't get all that recovery, but you get roughly 90% of it, or 9%. Now your 915 goes back to 997. Just an earshot away from your million you started with, but way better off than if you had gone down 10 with the market and up 10 with the market. The point is this: if you can protect to some degree your downside participation, you greatly enhance your upside recovery. This is a strategy Klarman and Buffett have lived by for decades. And this is also a strategy we use and apply to families and investors that we work with across the country. Number 3, investors ignore temporary price fluctuations. Speculators don't, gamblers don't, but investors have the ability to ignore temporary price fluctuations. If you have a $500,000 home and somebody walks up to you and says, hey, listen, I'll give you $150,000 for it today. You say, hey, thanks, but no thanks, take a hike. Because that's not the value of your home. Just because somebody, whether that somebody is an analyst, whether that somebody is the stock market for that day, whether that somebody is a talking head on CNBC, just because someone says something is X doesn't make it true. The value of an investment is where investors differ from speculators and gamblers. Investors like Buffett and investors like Claremont, when they buy something, they intend to hold it for long periods of time because they understand that if they can buy with and own investments with a margin of safety, with an eye towards avoiding losses, they're not worried about the temporary price fluctuations because it doesn't indicate or affect the actual value of the investment they own. Now, many of you may think, we're not Warren Buffett, we're not Seth Klarman. No, but these same principles have been tested both with fundamentals and over time, and hundreds and thousands of investors have followed these very things to help protect and grow their wealth over time. We've got a specific process, a specific strategy, but more importantly, a specific application to each individual family that we work with across the country to make sure that we are aiming to protect and grow wealth over time. Thanks for watching. I'll see you next time.